about common stock. And this is what we call variable income securities. Chapter 6 was fixed income securities, okay? And that was mostly bonds, okay? But this time we're talking about stocks. Oh, by the way, did anybody find the book which is not yours? I lost my book from the classroom. Someone? Oh, really? Okay, let me know after the class. Okay, thanks. All right, thank you. So common stock or stock market is very important. I know you are fully aware of that. And whenever you see the financial news, TV news or whatever, whenever they talk about financial situation, they show stock market on the screen. Okay? So stock, in a sense, is a representative of the financial instrument and the financial market. So let's try to understand what happens in the stock market, how to understand and how to evaluate the stocks. Okay? All right. Common stock is a permanent long-term financing. What that means is there is no maturity, okay? Like bonds. Bonds have maturity, so you can issue the bond, but after 10 years or 20 years, when the maturity comes, you have to pay it back. Right? But stock is ownership of a company. You're selling the ownership, okay? So it is not, there is no maturity. It's a permanent long-term financing. You don't have to pay it back. It also represents the true residual ownership of a firm. True residual ownership means, when all the debts are paid, when you pay all your liabilities, whatever remaining is owned by the owners. Okay? It goes to the owners. Okay? And of course, stockholders are owners. So if you own stocks of any company, then you are true residual owner. Okay? Whatever remaining after all the liability is paid, that's yours. Okay? Well, there are a few things that we need to understand. First of all, we're going to talk about this stock quotation table. And first column says year to YTD. YTD stands for year to date, okay? Which means starting from first day of the year, well, let's say 14th, to today. What happened to the stock price starting from the first day of the year until today, year-to-date percentage change. Okay? So if you look at the fourth column, there's a stock, the company name, and the fifth column is symbol. So whatever the DPL incorporated, the stock price went up by 0.5% between the first day of the year and up to today, or maybe yesterday. If this table was printed on the paper, obviously it was closing as of closing yesterday or previous trading day. Okay? And the second and third column show 52-week high and low. So during the last 1 year, 52-week period, what was the highest price and the lowest price? There was about $7.80 fluctuation between high and low for this stock. Okay, so you can quickly grasp what happened. What's the fluctuation in? If this is today, say May 2014, okay, shows May 2013. Okay, so what happened to the stock price? And let's say starting from the beginning of the year, right? How much was the appreciation and so on. So you can get quickly get the idea about the changes in the stock price. And the company name and the symbol. The symbols mostly in this table have two digits or 2 letters or 3 letters. Symbols are anywhere between 1 to 5 letters. NYSE, New York Stock Exchange symbols are mostly 1 to 3 letters. Okay? NASDAQ all the stocks listed on NASDAQ have 4-letter symbol. Okay? So let's see, what are the examples? P stands for AT&T. C, Citigroup, the financial corporation, Citi Corporation. Okay, I guess there's Citibank in Korea, right? Okay. F stands for which company? I think some of you did the project on this. Ford, yes, right? Ford Corporation. Okay. V, anybody? Huh? Visa, yes. Visa Corporation, okay. Going to NASDAQ, AAPL, Apple Corporation, right? How about CSCO? The Cisco, okay. It's a network equipment manufacturing company, Cisco, okay. But there are some interesting cases like ORCL. Yes, Oracle Corporation. Oracle Corporation makes the software, the database software. Okay? It's a very powerful database management software. And basically all the large corporations use Oracle database to manage the stock, inventory. Okay? And if you access your banking account, let's say 신한은행, and try to check your account or your transaction last 7 days, okay? You can easily see all those transactions. Okay? Think about this, even 신한은행, let alone a large bank like Bank of America. Okay? How many transactions they have in a day? It will be more than hundreds of millions of transactions every day, right? And out of all those transaction records, you can choose whatever you want. Your debit transaction or deposit transaction during the last 7 days or 30 days, whatever. So it comes up, the website produces this report as you order. Okay? That's what Oracle database does. Okay? It manages the data so efficiently and quickly. It can create customized reports very quickly. Okay? So it's a very powerful software. ORCL has a 4-letter symbol. Oracle has 4-letter symbol, but it is NYSE listed. Okay? So this is a special case. What happened was Oracle started as a NASDAQ company. Okay? When it went public, okay, it listed on NASDAQ company. Okay? But last year it switched the market from NASDAQ to NYSE. Okay? So NYSE allows the Oracle to keep the 4-letter symbol, okay? Because it will be difficult to change their symbol. It will be confusing for investors. Okay? All right. And then if you go to NASDAQ market listing, sometimes you will see 5-letter symbol. Okay? And let me have here. The last digit, last letter, 5th letter has a special meaning. You can read it. Okay. If it's A, it means A share. If it's B, it means B share. About the classes, we're going to talk about it in a few minutes. Okay. But all these last, the fifth letter has a meaning here. J stands for voting, K stands for non-voting. Interesting thing, Q stands for bankruptcy. That means the company is currently in bankruptcy. Okay? So, by looking at the symbol in NASDAQ market, you should be able to tell the current situation of the company. Okay, and then the next column is yield percentage. This is dividend yield. And yield percentage is annual dividend divided by the last price. Annual dividend divided by last price, of course, times 100 to make it percentage. Okay? So if you look at the second last column here, here's the last price. That's the price as of closing in the last session. When the market closed, the DPL stock was sold at $27.45. Okay? And if you divide this company's annual dividend payments by the last price, that comes out to be 4.4%. Okay, that's the annual dividend yield. Okay. PE or PER. Okay. In the United States, it's called the PE. In Korea, it's called the PER. Okay. It's price earnings ratio, as you know. Okay. And that's the last price divided by last 4 quarters EPS. So, more exactly, but sometimes it's called the P/E. Okay? Is last price divided by last 4 quarters EPS, earnings per share. Last 4 quarters earnings per share. Okay? So that's annualized. Okay? So total earnings per share and use the last price. And the unit is times. And depending on the industry, the average PE ratios are different. Okay? Some industries have a very high PE ratio. Okay? And I think you did in your project what those things mean. Okay? All right. And then the last column says net change. Net change is simply the change from the previous session. Okay? So by looking at this, for DPR stock, the closing price in the last session was $27.45. The net change was 0.26. That means compared to the previous day, this price, $27.45, is 26 cents higher. So you can figure out what the previous closing price was, right? It was $27.19, right? $27.45 minus 26 cents, okay? Because apparently during the last session, previous day, suppose this was today's table, which means it was as of closing yesterday, right? So as of closing yesterday, the price was $27.45. But in the previous day, so Friday, I guess, Friday last week, okay, it closed at $27.19, something like that. Okay? That's what net change means. Does it make sense? Okay? Good. All right. So you know how to read and understand the stock quotation table. All right. A little bit about the balance sheet accounts for common stock. I think we talked about this already, so I guess I'll be very brief. Okay. The par value of common stock is just an arbitrarily assigned nominal price of a share, right? It doesn't really have any realistic meaning. Okay? You know, when a company lists or issues stocks, okay, it is ownership of the company, right? And it's a security, right? So in their book, those securities have to have some value, right? But important thing is, of course, market value of the stock, right? But market value of the stock has nothing to do with the company's accounting, right? Because the owners are out there. The stocks are not owned by the company, right? Stocks are owned by individual or institutions, right? So for companies' standpoint, this market value has nothing to do with the company's book value. Okay? So in order to list the stock as one of their securities, you have to assign at least some value, right? So usually $1, $2, very minimum value. Okay? So that's what we mean by par value. Okay? And then contributed capital in excess of par or additional paid in capital, that's what the remaining value of the stock issuance is listed. Okay? So for example, let's say the company issues 1 million shares. $1 million shares at a par value of $1. Okay? But suppose they sold these shares at $10 each. Okay? So each share's market value was $10 per share. Okay? Then obviously they have received $10 million proceeds. It's called the proceeds. That's the amount of money the company receives by selling stock, right? So they sold 1 million shares at $10 each, right? So they received $10 million proceeds, right? That's an income or the amount of capital raised by selling stocks, right? But on the listing, the value of stock at par value will be only 1 million. 1 million, because par value is $1 per share, right? And the next line says contributed capital in excess of par or additional paid in capital. Contributed capital in excess of par, that would be 9 million. Okay? So total proceeds will be listed as a stockholder's equity, okay? But it will be separated between the par value and the contributed capital in excess of par, or additional paid in capital. Okay? So you've seen this kind of table before, right? This is the bottom part of the balance sheet on the liability side, right? On the liability side, you list the liabilities first, and after the liability, you list the equity. Okay? And preferred stock, apparently this company has issued preferred stock, right? You list the preferred stock value here. And the common stock, this company values the common stock at $2 par value. Okay? So there was 10 million shares. Okay? 10 million shares issued, 6.6 million shares outstanding. So what happened? They have issued 10 million shares of common stock, but currently outstanding is only 6.6 million. Any idea what happened to the rest? Company owns it, okay. Yeah, maybe they purchased it back, repurchased the stock, okay. Once they repurchase the stock, it's called the treasury stock, okay. I think we talked about it in one of the previous classes. Anyway, so the next line here is contributed capital in excess of par value, okay. And then the next line says retained earning. You know where retained earning comes from, okay? Every year company operates and generates profit, okay? And out of profit, part of the profit will be paid as dividend, paid to the stockholders as dividend, okay? But sometimes companies retain part of those profit, okay? And that becomes retained earning, okay? So the total stockholders' equity will be the summation of all these items: preferred stock, common stock evaluated at par value, and then contributed capital in excess of par value, retained earning. All those things make up the stockholders' equity. Okay? But the book value, when we say book value, which simply means total common equity. Okay. Another thing we need to learn here is book value. Book value is the value of total common equity. Only the common equity. Okay? So that will be stockholders' equity, total stockholders' equity, minus the value of preferred stocks. PS stands for preferred stock. Okay? And make sure you understand why we do that. Why? Why do we subtract the value of preferred stock when we calculate book value of the company? Preferred stocks are considered in many ways. In most senses, what? Debt. Yeah, it is considered a debt, right? So it's a special case, right? The stocks are ownership, common stocks are ownership, right? But preferred stocks are debt, right? Because in many senses it's very similar to debt instrument like bond, right? When the preferred stocks are issued, the company makes a promise to pay the interest, set amount of interest every period, right? So just like bond, they have it creates obligation, it creates liability, okay? So it is a debt, it's a liability, it's not equity, okay? So from the total stockholders' equity, you subtract the liability, right, to come up with the book value of the company. Okay? So if you want to calculate book value per share, then from the total stockholders' equity, $117,820, I guess it's million, right? Units are in thousands, so $117,820,000. From that, you subtract the value of preferred stock, okay? $37,500,000, okay? And then you divide it by outstanding number of outstanding shares, okay? And you come up with $12.03. So total book value total book value of the company is what's on top, right? On top of a numerator. That's the total book value of the company. Okay? And if you divide it by the number of outstanding shares, okay, then that's the book value per share. All right? Okay. Stockholders have certain rights. Well, first of all, most important right is dividend right. After all, that's why most of the people buy. Well, I guess that's not really true. A lot of people buy stocks for capital gain, right, instead of dividend right. Right? But dividend right is, on the surface, formally, it's the most important right of stockholders, okay? Because you are the owner, and owners are supposed to share the profit, okay? And the share of the profits are dividend. Okay? Asset rights, we're talking about in case company liquidates, company goes bankrupt, okay? And liquidate the company, right? Then the stockholders have asset rights. However, they are way at the bottom on the order, right? The first rights to asset goes to debt holders, like bond holders, and I think we talked about it in chapter 6. There are a few different levels of the bond. Secured bond, okay? Secured bond means when the company issued these bonds, they have put up some collateral, okay? So like machine or equipment or facility, right? So in case company defaults on this loan, right, the bondholders can come and take away these equipment and facilities, right? So secured bond, like mortgage bond, okay, has the top priority. Okay? Next to that is debentures. Debentures are unsecured bonds. Okay? So the bondholders can come and take away whatever remaining in the company. Okay? And after all that, I mean, there may be some other debt holders like bank and other loan companies. Okay? So after all the debt holders satisfy whatever they, have the ownership of the company, right, or of the asset, if there is anything left, right, then stockholders can take a swing at it, right? So what that means is typically there will be nothing left, right? So asset rights are not very important for the stockholders. I don't think anybody expects, right, these asset rights when they buy stocks of a company. Okay? Preemptive rights. I need to write down something. Okay? Preemptive rights means existing shareholders have right to purchase newly issued shares up to the proportion of current ownership, up to the proportion of their current ownership. So in case company decides to issue more shares, issue new shares, okay, then existing shareholders have their first right, okay, or sometimes it's called the first right to refusal, right for refusal. Okay? So they should be offered the first. If you don't like it, if you don't want to purchase any more shares, that's fine. You can refuse it, right? But at least you have to be offered first. Okay? So up to their current ownership, if you own 5% of the current shares, okay, then whatever the new issues or new shares are issued, right, you have right to purchase up to 5% of the newly issued shares. Okay? Why? What's the justification of this? What's the purpose of this rule? Preserve the ownership to prevent what? What's the word? Huh? To prevent what? What do you call this? Adding water to wine? Dilution or dilution, right? To prevent involuntary dilution. Okay? What that means is if this does not happen, right? If company issue the new shares and just freely sells just public, right, without offering to the existing holders first, right, then your current share of 5% can be diminished, right? If the company issued new shares, right, now your share is not up to 5%, right? It can go down below 5%, right? That's the idea of dilution, right? Okay, preemptive rights, okay? And then voting rights. Voting right is another important right, okay? Especially for major holders, okay? For minor holders, voting right is not very important, right? If you own some, let's say, 100 shares of Microsoft stocks, right, your importance will be very small, right? And of course, you will be given voting right, but typically voting right proportional to the number of shares you own, right? So if you're only holding 100 shares out of millions of shares of Microsoft stock, then your vote will be probably 1 in million of one vote, 1 millionth of one vote, right? So you won't be able to do anything with that, right? So every year when the time for their regular stockholders meeting comes, right, all the shareholders receive a mail. It used to be real mail in a thick envelope, right? But these days, everybody sends these proxy statements through email. Okay? Really, it happens. If you own any stock, you will receive this mail, right? Your investment company, if you have your account in any investment company like E-Trade, right? They provide your information to the Microsoft, right? So Microsoft has all the list of stockholders, right? And they are supposed to notify all the stockholders of this upcoming stockholders meeting, okay? And they also send a proxy statement, okay? What that means is, in case you don't want to attend the meeting, you can delegate your vote to someone else, okay? So if they are asking you to delegate, you give your vote to someone else, okay? To the management mostly, okay? Okay, so voting right is very important. What do they do at the stockholders meeting? Most importantly, elect board members. Okay, that's the very most important thing, right? And board members will decide whether they're going to keep the management or not, okay? Or find a new CEO and so on. Okay? But sometimes, if there is a very important managerial issue, like acquisition or merger with other company, okay, then those things can be put up to vote in the stockholders meeting. Okay. Well, there are lots of other things, but we'll talk about voting rights in a few minutes, more specifically. Okay? Other features of common stock classes. Many stocks have different classes, A shares, B shares, and C shares sometimes. Okay? I think I told you about the Berkshire Hathaway, okay? BRK. Did I? Berkshire Hathaway. Whose company is this? Yes, Warren Buffett, right? The most revered investor, Berkshire Hathaway, right? Symbol is BRK, A, BRK, B. I didn't check the prices recently, but as of last year, okay, it was A shares were $160,000 per share. Okay? B shares were only $106.12. Okay? So there is drastic difference between A shares and B shares. Okay? If you want to invest in A shares, you better have a lot of money. Okay? And the difference is B shares have 1 in 200 voting right. Okay? So if the A share owner has 1 vote per share, right? Then in order to have 1 vote, you have to have 200 shares of B shares. Okay? So why do companies do this? Do they issue different classes? Right? Mostly to control the votes or voting power. Okay? So especially the owners. If the owners have major shares, right, and they don't want to lose the ownership of the company, right, then they can issue different shares, right, and mostly A shares are retained within the family, okay? And they sell B shares to public. Okay? So, what they're telling is, okay, you can invest in this company and you can make money, right? But don't get into the management. Okay? Don't get into the control of the ownership or managerial issues. Okay? Just invest your money and make return on that money. Okay? Right. This Google share is very interesting. It just happened about a month ago, April 3rd of 2014. Okay? Apparently they used to have A shares and B shares, okay? But about a month ago in April, they issued the C shares. Okay? And let me just read this couple of paragraphs here. A new C class of Google shares will begin trading on Thursday, that was April 3rd, okay? Under the familiar GOOK ticker. Okay? The stock gives its owners 0 votes. It's a non-voting share. Okay? At the annual shareholder meeting. That sounds bad. In practice, however, the non-voting shares won't be so different from holders of Google's A-class shares, which get 1 vote apiece. Okay? Both groups are dominated by holders of the only shares that matter, which is Class B shares, okay, with 10 votes each. Okay? And most of these B shares are owned by Google's founders, Sergey Brin and Larry Page. Okay? So we have A shares, B shares, and C shares. Okay? A shares get 1 vote per share. B shares get 10 votes per share. C shares get 0 votes per share. Right? So you may think, hey, C is really not as good as A, but in reality, this one, even A shares don't make any difference, okay? Because B shares, most of the B shares are owned by two guys, okay? There's two owners, okay? Sergey Brin and Larry Page, okay? So basically, these two guys can do whatever they want with the company, right? They don't have to worry about other people, right? Now, Page and Brin aren't satisfied with their 55.7% majority of votes they already control today. As Google issued less potent A shares to compensate employees or to finance acquisition, okay, the company's founders have seen their voting power diluted. Okay? So, the reason why they issued the new C share was, they have clear majority right now, almost 56% of the votes, right? And with that, they can do whatever they want, right? But they occasionally saw the needs to issue additional A shares, right? Sell additional A shares to compensate their employees. Sometimes you have to give stock options, right? So after that experience, they were worried that their control of the votes may weaken, right? So in order to avoid that, they now issue a new share, non-voting share, okay? But people are happy to buy that still, right? What's the price? What's the price? Price was 500 something, right? It was not this. Right. This article doesn't show the price. Okay. All right. So that's the reason why the companies issue different classes. Okay? Ford is also, I think that's the classic case, right? The Ford Motor Company, by differentiating the classes, the Ford family is still maintaining the majority of the vote, okay? And they have clear control of the direction of the company, okay? Okay, stock splits, reverse splits. All right, well, since the textbook talks about it, let me briefly mention it, right? Sometimes companies announce stock splits, say 2-for-1 split. Okay. What that means is if you are currently owning one share of this stock, suddenly you have two shares. Okay? But it's not like you are becoming twice as wealthy, right? Because as soon as they split, what happens to the price? Yeah, price becomes half, right? So if you owned $10 stock, right? And it used to be $10 until closing of yesterday, but today they announced 2-for-1 split, right? The price goes to $5, okay? But your wealth is the same because you now have two shares, right? 2 shares times $5, okay? So why do they do that? Any idea why do they split the stocks? To lower the price. I'm sorry, what? Is that what you said? Yeah, to lower the price, right? Yeah. Why? Why would company lower their stock price? Didn't they try to increase the stock price? Yeah? Earnings per share? No, it's not going to affect their earnings per share, right? To buy more, right? In other words, to make their stocks affordable, right? So typically there is a range of stock prices that the market in general consider that this stock is affordable, right? anywhere between, according to our textbook, anywhere between $10 to $60. Okay? Well, in the United States. I guess in Korea, I don't know in terms of what's the affordable price range, right? But in dollar stocks, typically anywhere between $10 to $60 is considered normal range of the stock prices. Okay? So if it becomes way outside this range, right? Like $150 or $300 or $500, right? Then it may become a little bit difficult for average investors to get in, right? You know, with your money you can buy only 10 shares, right? Okay? And in stock market, 100 shares are considered round lot. I don't know what's called in Korea, okay? But in English it's called a round lot. Okay? So what that means is if you place one order, that means 100 shares. Okay? So if you want to buy 160 shares, then it's not a round lot, and I don't think you can place it through an automated system. Okay? You have to probably use your stockbroker assistance. Okay? Okay? So, you know, in order for people to easily get into this stocks and purchase the stocks, right? If the price goes too high, right, then there may be a problem. Okay? So that's the primary reason why the companies are now split. Okay? Does that mean if you look at the historical chart, stock price chart, it goes like this and suddenly it goes drop? Do you understand what I'm asking? Right? Will you see this kind of chart? Not really. Okay? As soon as the stock split is completed, this chart will be adjusted, right? So all the old prices will be adjusted to the new price, right? So you will have smooth, the comparable chart, okay, in stock prices. Okay? But if you really want, I think in many stock charts make a note here, okay, 2-for-1 split, 2-for-1 split at this point, and so on. Okay. Okay. Reverse split is the opposite case. Okay? It's 1-for-2. So what that means is if you're currently owning 2 stocks, suddenly it becomes 1 share. Okay? So company reduces the number of shares. Okay? And the reason is, of course, if the price becomes too low, okay, then it's not really desirable in many senses. Right? So in order to increase the stock price, I guess it typically happens when the company is not doing well. Something happens like financial disaster. I think if you read the chapter gives the example of AIG Insurance, okay, which had been hard hit during the 2008-2009 financial crisis. Okay? So their stock price became something from $200 to $2. Right? So that's when the reverse stock split happens, okay? To increase the stock price. Okay? Stock repurchases, companies buying back their outstanding shares. Okay? Why do they do that? Well, there can be many reasons. First reason, disposition of excess cash. Maybe like Microsoft, okay? They have too much cash, okay? And just don't know what to do with the cash, and there isn't any better way to invest this cash, right? Then one thing they can do is purchase their stocks back, right? Okay? And you know, repurchasing or reducing the number of shares have many benefits. Right? Financial restructuring. One of the main topic of the next semester, the Financial Economics 2, is capital structure. When we say capital structure, it simply means one thing: debt equity ratio. Okay? So when we say capital structure, we're talking about debt equity ratio, right? When company has too much debt, right? Or they need to increase the equity or reduce the equity, right? Then they can repurchase the stock, okay? And I guess that's the opposite case, right? If you repurchase the stock, equity will go down, right? And debt, well, debt may not increase because they may be using the cash holding, right? But for some reason they need to rebalance the debt equity ratio, they can use the repurchase of stocks. Okay? Future corporate needs, well, in case they foresee the needs to use their stocks for stock options or and many other reasons, okay? Then they can purchase. One of the most important reasons for repurchase is reduction of takeover risk. Okay? If you have too many shares outstanding, right, then it becomes a very easy target of corporate takeover. Okay? Because first of all, price will be low. Okay? So other companies who want to overtake your company can easily purchase your stocks, okay, without you knowing. Okay? So by repurchasing stocks, you can actually raise the price, okay? And it may make it more difficult for takeover attempt. So we are in the middle of chapter 7, which is about the variable income security, in other words, stocks or common stocks. Okay? And we last class we talked about some definitions and some introductory concepts of stocks. Okay? And let's continue with that. So voting is a very important right for stockholders, common stockholders. And there are a few different concepts relating to voting. First of all, majority voting. Majority voting is more popular, the most popular way of collecting the votes and making decisions at stockholders' meeting. It's just like a regular election, and whoever gets majority gets elected. I mean, the most important decision made at stockholders' meeting is electing the board members. Okay? So whatever the candidate you have, collecting the majority votes gets elected. That's majority voting. Okay? But the problem with majority voting is if you belong to a minority view, then you may not be able to elect anyone of your choice. So whoever, and there may be two factions in among the stockholders, okay? Then whoever holds the majority votes can elect everyone. Maybe you have 9 people in your board, okay? Then all 9 people will be elected by this majority party or faction, okay? And those people that belong to the minority view may not be able to elect anyone in the board. Okay? So to correct that problem or to improve that situation, some companies have cumulative voting. And cumulative voting means people get equal number of votes as the number of people being elected. So if you are electing 7 people, or this time maybe you are electing only 5 people out of 7-member board or 9-member board, okay? Then everybody gets 5 votes. Okay? And of course, the number of votes will be multiplied by number of shares you own, okay? Because number of votes you get will be proportional to the amount of shares you have in your company anyway. Whether they use majority voting or cumulative voting, that's the same. Okay? The number of votes you get will be proportional to the number of shares you own. If you own 1% of the total shares, then you should get 1% of the total votes. Okay? The difference between the majority voting and cumulative voting is you can, whatever number of votes you get, you can cast all the votes to one person. Okay? So to make it, I guess, easy to understand, let's say you are electing some number of people in your member vote, and let's say we have candidate Bob, Mary, Judy, Jack. If this is a majority voting, then you can cast only up to 1 vote for each person, right? So maybe you can check Bob and Judy of your choice, right? Or if you like all of them, then maybe we can check all of them. Okay? In the cumulative voting case, you will actually be able to indicate how many votes you cast for each person. So if you get 4 total votes, you can maybe distribute 3 and 1, 0, 0, something like that. Okay? Or if you like, you can give all 4 votes to Mary, if you like. Okay? And of course, all these numbers will be multiplied by number of shares. If you hold, say, 1,000 shares. Okay? All right. So the difference in consequence is if you concentrate, or if you somehow make an alliance with other minority few members of the stockholders committee, right? And if you say, okay, we need to elect at least 1 person into the board, right? So why don't we concentrate our vote to Mary? Okay. Then you can elect at least 1 person or maybe a couple of people into the board by concentrating your votes. Okay. All right. So here's the formula in case there is a cumulative voting. Number of shares necessary to elect a certain number of directors. That is number of directors desired times number of shares outstanding. Actually, this should be the number of shares being used or being cast, number of ballots being cast. In other words, outstanding shares may be 1 million, but not all 1 million shares may be used, or actually shareholders actually participate in the vote, right? If only half of the shareholders participate in the voting, then that's 500,000. So instead of 1 million outstanding number of shares, okay, you should use actual number of shares participating in the vote. Okay? So that's should be number of votes, number of shares participating in the vote. Okay? Divided by number of directors being elected plus 1, the whole thing plus 1. Okay? So why don't we have some exercise trying to understand this formula. Why don't you open self-test question number 3. comparing to equity financing. Okay. I told you there are only two ways of financing or raising capital for a company. Do you have a question? Please, anybody have a question? Try the other problems. If you have any question, let me know that next time, okay? All right, so as opposed to equity debt financing, what's the advantages and disadvantages of equity financing? First of all, advantage is flexible. In other words, there is no fixed dividend obligation. There is no fixed dividend obligation, okay? Because if you raise capital through bonds or preferred stock, then you have obligation. You are supposed to pay the interest payment every 6 months. Or if you issued preferred stock is just like a debt, right? So every quarter you are obligated to make the dividend payment, okay? But with the common stock, you don't have to. It's very flexible. If you have a lot of profit, you can decide to distribute the profit through dividend. Otherwise, you don't have to, okay? Reduced financial leverage. Again, leverage simply means debt, right? So since you have raised capital by selling your ownership, you didn't have to increase your debt, right? So that sort of relieves you from the burden of debt service cost, right? In other words, interest payment. You don't have to increase interest payment on your management, okay? And then lower cost of capital. Again, the same idea. There is no debt servicing cost while you raise the capital, so cost is lower compared to the debt financing. Okay. Disadvantages, of course, it dilutes EPS because you're creating more shareholders, you're creating more owners, you have more people to share your profit with. Okay. So that's the problem. And also it is expensive. It is expensive in the sense that dividend payments are not tax deductible. While the interest payments on bonds are tax deductible. So when you issue bonds to raise capital, and when you make the interest payment every 6 months, you can deduct that cost from your profit. So that reduces your tax obligation. Okay? But when you pay dividend on common stock, those costs are not tax deductible. Okay? So in that sense, it is a little bit expensive. So there is, the trade-off. Okay? It lowers the interest cost, but it increases the tax obligation. Okay? So you have to make a decision by weighing the cost and benefit. Okay? All right. This chapter also discusses some details of the security offering process, especially the role of investment banker. And large corporations usually have some investment banking companies linked to the company, right? And they constantly get consultation from the investment bankers in the areas of long-range financial planning, timing of security issues. In other words, when a company needs to raise more capital, and they should consult the investment banker. Investment banker should be able to advise whether a bond is better or stocks are better at this time, right? Considering the market condition, right? And also whether this is a good time to issue the stocks or bonds, right? Obviously, if the market is depressed, then you won't be able to raise a lot of capital by selling the securities, right? So maybe they would advise you to wait until next year, something like that. Okay? Purchase of securities. When you decide to issue the bonds or stocks, then the investment bankers will underwrite. Underwriting typically means your investment banker will purchase all your stocks and all your new issuance of bonds, and they will try to sell them to general public or other institutional investors, like pension companies or commercial banks. Okay? So that's what we're talking about: purchase of securities, marketing of securities. Yes, investment banker purchases securities from you, your company, and then they will market the securities to the investors. Okay? Arrangement of private loans and leases, in addition to raising capital through bonds and stocks, sometimes you can get private loans from private investment companies, private investors. Okay? And also when you need to lease certain things such as equipment, airplane, or building, facility, land, all those things, right? The investment banker can get in the middle and try to find the best deal or best way to finance all these leases. Okay? And finally, negotiation of mergers and acquisition. Okay? Investment banker plays a very, they play a key role. Okay? If a company wants to sell the company, right, then they will find an investment banker to find a potential suitor, potential buyer, okay? And these potential buyers will visit your company, the company who's trying to sell the company, right? And when they come, they maintain anonymity, okay? So you have no idea who's coming, because until the final deal is made, right? Until the negotiation becomes very serious, it is important to maintain anonymity, secrecy of who's trying to buy whom, right? So I heard from one of my friends who got involved in this process, right? And you have to get rid of anything that can hint to your company, even the wristwatch. Because sometimes the watches are issued by the company. It may bear some company logo or name, right? So it go in 100% anonymity. Okay? It's an exciting process. Okay. So security offering process. What kind of processes are involved here in selling the securities? Okay. Well, there are public cash offerings and private placements and right offerings and standby underwriting. Public cash offerings is a more common way of, what we call IPO. Right? Well, IPO is one of the public cash offerings, okay? Initial public offering. Okay? And the negotiated underwriting means the company that's issuing the security or common stock negotiates with IB or investment banker. Again, the most large corporations have their own investment banker maintain constant relationship with investment bankers. Okay? So they will make some negotiation. Hey, we need to raise some capital, say $500 million. Okay? And the investment banker will advise what is the best way right now and what kind of interest rate you can expect, and so on. And of course, the investment banker will get a fee, okay? Underwriting fee. Okay? So that's the idea of negotiated underwriting. Again, the underwriting means the investment banker will purchase entire issuance of the stocks or bonds from the company, okay? And they will try to sell them to the investors. Okay? That's the first type of public cash offering. Okay? And in most cases, the large private corporations will go with negotiated underwriting. Okay? Competitive bidding is typical in more public companies, okay, or publicly regulated companies, like electricity utility companies, railroads companies. Okay. In Korea, I think there is a corporation called LH. What does the LH stand for? Oh, land and housing, maybe land and housing. Yeah, so I guess that's what's in Korean name. 주택공사, is that right? LH. Isn't it 토지개발공사, something like that? No? Alright. Yeah, suddenly since about 20, maybe 15 years ago, all the companies decided to use this English initial rather than their name, okay? Like LG. Does anybody know what LG come from? Yeah, Lucky Gold Star. Yeah. Yeah, Lucky was a company that used to produce toothpaste. Okay? That was the only product of Lucky, when I was little. Okay? Lucky toothpaste. Okay? And then they merged with Gold Star, which was an electronics company, and became LG. Okay? And I guess it's the same in Korea, but in the United States, they advertise LG as life is good. Right? Life is good. That works. Right? Okay. Anyway, so if LH in Korea would issue any of their stocks or bonds, they'll have to, probably, I'm pretty sure, they'll have to use a competitive bidding instead of going through with the investment banker. Right? Well, of course, investment bankers can participate in competitive bidding, right? But instead of negotiating directly with the company, you have to go through the public bidding process. You know what bidding process is, right? 입찰. Not 경매. I can say 경매 입찰 or public bidding. 공개 입찰, something like that. Yeah. Anyway, right. So you have to go through the bidding process in order to get the best bid, right? The highest price for your security you're issuing, right? But that's mostly a publicly regulated company. The whole purpose is to protect the general public because it's a public company, right? Something like LH is a public company, so it is. You need to protect the interest of general public. Okay? Private placements means sometimes when a company needs to raise capital, investment banker finds instead of issuing the stocks and bonds and try to sell them to general public, they'll find a private investor or private investment company, right, to acquire entire issuance, right? So whatever amount of stocks or bonds a company A is trying to issue, instead of trying to sell all those things to general public. In other words, the IB, investment banker, is making some matchmaking. Okay? You find the seller and buyer and connect these two companies. Okay? So you basically borrow money from one private investor or investment company. Okay? That's the idea of private placement. Okay? And this is more popular, more frequent among the smaller companies, smaller corporations. Okay? Because smaller corporations are not very well known to general public, right? So if you try to sell the stocks of company XYZ in the market, the general public may not be very much interested in buying these stocks, right? And the company may not be able to raise a lot of cash. Okay? So in that case, the investment banker may contact some private investor who are more savvy and own some more technical ability to analyze the company and convince this investor that, hey, this company XYZ, even though this is very unknown and small company, it is a very good company with a lot of potential. Okay, so convince the investment company to buy the security of this company in private without going through the public process. Okay? The benefit of that is the flotation cost is typically smaller. What is the flotation cost? Flotation cost is, in other words, issuance cost. Issuance cost. That's basically the fee that investment banker will charge the company for helping their issuance. Okay? And it includes finder's fee, that is the case of private placement, right? Because the investment banker finds a private investment company who will purchase this issue of stocks and bonds. The investment banker receives finder's fee, just like professional matchmaker charges fee for finding your spouse. Okay? Underwriting fee. This is the case of more of the negotiated underwriting case. Right? So if you go through private placement, then you may not have to pay underwriting fee. Instead, you will have to pay maybe smaller finder's fee. Right? And then there are lots of other costs like filing costs and so on. Right? You have to file a lot of documents with the Security and Exchange Commission, right? So there are lots of legal fees and expenses, right? So all those fees are included in flotation cost or issuance cost, right? But typically the flotation costs are lower if you go with the private placement. Okay? Finally, the rights offering and standby underwriting. Rights offering, sometimes it's called privileged subscription, okay, is the case when the company is trying to sell new shares to existing shareholders, okay, by giving the special rights, something like preemptive, the similar concept of preemptive rights. Okay. So when they try to issue new shares, right, they notify the existing shareholders and say, you have 30 days to purchase. If you want to purchase additional share of this new issuance, right, then you have 30 days until, 30 days to purchase the shares. Okay? So that's rights offering. Okay? And standby underwriting means when the company issues the rights, the investment banker may purchase entire issuance of the shares, okay? And whatever the existing shareholders may not purchase, right? Then the investment banker will try to sell them elsewhere. Let's say the company issued 10 million shares and offer the entire 10 million to the existing shareholders in terms of rights, okay? But let's say they were able to sell only 8 million shares. So 2 million shares are remaining, right? Then if you have standby underwriting agreement with the investment banker will try to sell, well, they are obligated to sell the 2 million shares to somebody else. They will try to find some other people or company to purchase remaining shares. Okay, Facebook IPO fiasco. It's kind of old now. It's been about 2 years since Facebook went IPO, and I think the initial price they wanted was about $37. Okay, but the price did not go up to that level, and I guess it was very disappointing for Facebook for not raising enough cash as much as they wanted. Okay, and I'll have to skip this. If you want, you can find this on the internet. So let's here I'll talk a little bit about that when we talk about this other insurance cost. Okay. All right, so rights and warrants and options. These are all some special concepts related to stocks. Okay, we talked about rights already. Rights is the case where the company tried to sell new issuance of stocks to the existing shareholders. Okay. Warrants, similar to rights, but warrants are usually issued with other instruments by companies. As what's the term? In order to make, in order to sweeten, as a sweetener. Sweetener. That's the term that they use in finance. Sweetener, like sugar or sugary subject. Equal. Do you use equal or what? Okay. Artificial sweetener. Okay. So when a company issues a bond, let's say, okay, in order to make it more attractive to the investors, they may attach some warrants to the bond. Right? So if you purchase the bonds of company XYZ, you may get some warrants as well. Okay? The concept of warrant is, let's say, in 5 years, you can buy the shares of XYZ stock. Let's say XYZ company is issuing bond, say 20-year bond, and it promises a 7% coupon rate. Okay? But being a not very well-known company, investors are not very much interested in this 20-year bond with the 7% coupon rate, right? So XYZ company may attach some warrants. Okay? Warrants it's a kind of option, right? If you want, you can purchase the stocks of XYZ company within 5 years at say $10. Okay? And current stock price of XYZ is $15 or maybe $10. Right? So what that means is, regardless of stock price 5 years later, right? Maybe stock price may go up to $20 or $30 5 years later if the company is successful, right? But you can still purchase their stock, let's say 1,000 shares of their stock at $10. Okay? So it's kind of bait or sweetener, right? To make the issuance of bond more attractive. Okay? And the options are issued by option writers. So difference between warrants and option is this. Warrants are issued by company itself. Okay? But the options are issued by option writers for other traders. Okay? So if you purchase an option, then you have a right to purchase stock at certain price within certain time limit before the expiration date. Okay? Or there can be 3 months option, 6 months option, and so on. Right? So actually option and other derivatives are topics of second semester finance economics. If you are interested, you can learn at that time. Okay. But, well, let me just give you a quick idea. Just like this, right? If you let's say GE, current stock price is $20. Okay? And there are actually call option, put option. Call option means you have a right to purchase the stock. Put option means you have a right to sell this stock. Right? So if you are currently holding GE stock in your position, in your account, right, then you might want to buy put option, right? And let's say put option at $20 or $20.50, whatever. Okay? And 3 months later, expiring, say August 30, 14. Okay? So what that means is on the expiration day, well, there are American option and British option. There are two different types of options. The difference is American option you can exercise any time before or until the expiration day. Okay? British option, is that British option or European option? Yeah. European option, right? Yeah. You can exercise only on the expiration day. Right? So if you are holding American option, right, then you can sell your stock, GE stock, at $20 anytime before August 30 or until August 30. Okay? Even if the actual stock price goes down to $18, right? So that's an insurance, basically. You are paying, when you purchase this option, of course, you have to pay premium. Okay? Just like when you purchase your auto insurance, you pay premium. Okay? And, well, what if the stock price goes up to $22? Are you going to exercise your option, put option? No, you don't have to, right? Because your stock's worth more than $20 that you can sell at, right? So, you know, like auto insurance, you pay for the 6-month premium. If you get into an accident, then you can make a claim and get some benefit from the insurance. But if there is no accident for 6 months, then you just lose your premium, right? The insurance expired, right? So just like that, right? That's an insurance. I used to sell or write GE put option. It's again I was an option writer, right? So what happens is that was about middle of 1990s, okay? And at that time GE stock was about $20, okay? And GE stock just kept going up and up. You know, you probably heard of this 1990s, right? It was a really good time for stock market, right? The stock market just kept going up, right? And the GE stock just kept going up, right? So I sold the put option. So those people who purchased the put option from me, in case GE stock goes down, they can sell it to me. In other words, I am obligated to purchase at higher price than the market price, right? So that's not good for me, right, if they exercise. But fortunately, because stock price just kept going up, people just, you know, didn't exercise, and every 3 months just the put option expired, right? So what's the benefit for me? Premium, yes. When I sold this put option, I received the premium. That was about, if you sell about 1,000 shares, okay, so that's $20,000, then I get about $600 premium, right? So you don't have to invest $20,000. All you need to do is have your money in your stock market account. I went with the E-Trade. Okay? So as long as I have this money in the E-Trade account, they allow me to sell the put option. Okay? Actually, half of that amount, because I can use the margin account. Okay? So just kept receiving premium. Okay? So even if worst thing happened, worst thing is stock price goes down and the people exercise. Right? Then when the stock price is $18, I have to pay $20 and buy the GE stock from them. Right? But still, GE is a good company. Right? So if you just hold them, it'll go up. Right? Sooner or later. Right? So it's a very minimum risk, right? People think derivatives or option trading is very risky. It is risky. You have to be careful, right? But there are some ways you can. The thing is, the people who take risk, they want quick profit, quick money, right? So they will never get into this thing. This is boring, right? I just did this as a learning process for the stock market. Somebody who works for GE actually recommended that to me. Okay? So that's why I got into that. But in the next semester, when you learn option trading or the concept of option, you can learn many interesting things about options and other derivatives. Okay, so we are almost done with this boring concept thing. Right? So issuance cost, I already talked about underwriting cost. Right? There is what's called the underwriting spread. Yeah? That's the difference between the selling price to public minus proceeds to company. In other words, what's the difference? Who gets the difference? Selling price to public. Who gets the difference? Underwriter, yes. Who's the underwriter? Investment bank, right? Yeah, that's the direct issuance cost. So there's underwriting spread, and there are other issuance costs. Okay? I mentioned the finder's fee and legal fee and filing fee and all kinds of things. Filing fee is related to the registration requirements. Okay? In order to sell your stocks in the market to public, you have to register. In other words, you have to file a lot of documents. Right? There are tons of documents you have to file. While you guys are doing the project last time, maybe you have seen, when you try to obtain some financial statement, did you see something like 10K, 10Q, right? Fine. I don't know what they use in Korea, but in the United States, if you try to obtain the financial documents, financial statement for Ford or other American companies in Yahoo Finance site, you may have seen 10K, 10Q or something like that, right? There are about 20 some different documentations that the company has to file with SEC. SEC, the Security Exchange Commission, right? And it's a government oversight organization. Right? 10K is an annual report. 10Q is quarterly report, okay, that you have to file. Okay? And it takes a lot of time and effort and money to, it's costly to file these requirements, okay? Require the documents. So, other issuance costs, I was going to talk about this Facebook IPO fiasco. Okay? One of the functions, one of the role of the investment banker when they help with IPO, initial public offering, right? They have to come up with about appropriate pricing, right? when a company tries to issue their stocks at first time, right? What's the price they're going to sell or what's the price at which they're going to issue the stocks, right? If you go too low, then of course you lose a lot of money, right? Because you could have raised a lot more capital, right? So you don't want to go too low, right? You don't want to go too high, right? Because if you set the price too high, then actual stocks may not sell, right? You have a lot of remaining stocks, and then public image will be damaged, right? This company tried to sell their initial public offering, right? But somehow people are not interested, and they didn't pay the price, right? Then, well, this can be taken as a public assessment of the company is not that good, right? So that's a part of issuance cost, right? As I think the chapter mentions, right? Shelf registration is a kind of simplified registration process because the registration requirement is so complicated and it's an arduous process. So you have to file so many documentation, right? So government is trying to help the companies by allowing shelf registration. Again, this is a simplified registration, but this is allowed for only the large corporations with good credit rating. Okay? Only the reliable companies can take advantage of shelf registration. Okay? So what this means is I think you can find the definition in the book, right? You can file a master registration, and then without filing any additional documents like quarterly report or annual report, right? You can sell small increments of stocks for the next 2 years. Okay? So instead of filing all these documents every time you issue new stocks, right? You can file just one time, one master registration, right? And for the next 2 years, you don't have to file any more documentation. Okay? That's the idea of shelf registration. Okay? But again, it is available for only the larger company with a good credit standing. Okay? Okay?